So far we have been discussing comprehensive income statement of a company. So that today we are going to discuss further about that lesson. Now, just try to understand, we know the format of the comprehensive income statement based on LKA is, that is 1. And then thereafter we have to discuss, and you know that this is the accepted format of comprehensive income statement. And then you know some disclosures and workings related to that is comprehensive income statement. And thereafter we have to discuss what you call statement of equity changes. Understand, we have discussed statement of equity changes. Here know that based on LKS 1 and also entity concept, you have to write the name of the business as Provenic PLC or something, and then you have to write the accounting period based on periodic concept, as well as based on money measurement concept, you have to write the values. And then here you see, now company is concerned, equity of the company comprises of 4 components. First one is ordinary shares, the other one is revaluation reserve, the other one is general reserve, the other one is retained earnings. Now these are the 4 components of equity of a company. Then you see this is the opening balance of ordinary shares, revaluation reserve, general reserve, and retained earnings. This is the total. And then if there is share issue during the period, due to share issue, what happened is that ordinary share value increases. Ordinary share value increases. Now double entry for share issue, when shares are issued, cash control account debit, and then ordinary share account credit or stated capital account credit. So that due to share issues, what happened is that ordinary shares, that is a stated capital increases. So that once again I am explaining you, the double entry of share issue is what you call cash control account debit, and then ordinary share account or stated capital account credit. So that due to share issues, what happened is that ordinary share account or stated capital value increases, no effect on other component of equity. And then you see, you calculate the comprehensive income from the comprehensive income statement. And comprehensive income comprises of 2 components. First one is what you call profit for the year. The other one is called other comprehensive income. Other comprehensive income. So that profit for the year, that portion should be recorded in the retained earning column. Retained earning column. Here, the profit for the year should be recorded under the retained earning column. You see that part should be recorded here. Retained earning column. This is the portion that we have recorded. And then comprehensive income, part of the total comprehensive income, should be recorded under the category of, that is what we call revaluation reserve. So that total comprehensive income that we have calculated in the comprehensive income statement should be taken here, and that total comprehensive income should be recorded the portion of profit for the year under the category of retained earning, and then the portion of comprehensive income should be recorded under the category of, that is revaluation reserve. And then if there is any right share issue, sometimes you see the board of directors may decide to issue right shares. Normally right shares are issued to existing ordinary shareholders. If right share is issued, double entries, cash control account debit, ordinary share or stated capital account credit. So that when right share is issued, you see ordinary share account or you see stated capital increases, so that in stated capital column, you see value increases. Then you see revaluation of right share issues. Then reserve capitalization. Reserve capitalization means, you see, issue of bonus shares. Issue of bonus shares means to the existing ordinary shareholders, the board of directors can distribute certain amount of profit among ordinary shareholders without charging money. Without charging money. That is what we call issue of bonus shares, or that is called capitalization of reserves. Then what happened is that due to capitalization of reserve, this is what happened. What happened is that it increases due to capitalization of reserve, increases stated capital amount, and then decreases either retained earning or general reserve. Normally, you see, reserve should be taken from this capitalization of reserves. First, normally we take out of the retained earning. If there is deficit for capitalization, that deficit can be taken from the general reserve. Understand? Now, for example, bonus share issue is 1,000. Assume that bonus share issue, the value of the bonus share issue is 1,000. Here in the retained earning account, you see the balance remaining is 900. But the bonus share issue is 1,000. So that 900 should be taken from the retained earning account. The rest 100 should be taken from the general reserve. So the double entry is that 900 retained earning account debit, general reserve account 100 debit, both are credited to stated capital account. Once again, if the company issues 1,000 value of shares, retained earning account is having only 900. So that total of retained account amount should be taken for capitalizing, and the rest 100 should be taken from the general reserve. Double entry is that, or journal entry is that retained earning account debit 900, general reserve account debit 100, total is credited to ordinary share account or stated capital account. So that out of retained earning, 9,000 is decreased. Out of general reserve, 100 is decreased. Total, due to total ordinary share account increased by 1,000. That is what we call capitalization of reserves. Then you see next one, transfer to general reserve. Now, general reserve is a normal special fund kept for special reason. That special reason may be decided by the board of directors. We don't know that special reason. Sometimes for bonus share issues, maybe. Sometimes to purchase certain amount of property, maybe. Whatever the special reason, it may be decided by the board of directors. Out of the earned profit, every year, certain amount can be transferred to general reserve. Understand? If general reserve is, if certain amount is transferred to general reserve, what happened is that retained earning account debit, and then general reserve account credit. Then what happened is that retained earning value decreases, general reserve value increases. That is only happen. Interim dividend. Interim dividend means, you see, before paying the final dividend, the board of directors can decide or propose to pay a certain amount of dividend in between the period. If such amount is paid, that is what we call interim dividend. That is called interim dividend. Dividend paid before paying the final dividend in the end of the period. In between the period, the board of directors can decide of paying interim dividend. If interim dividend is paid, what happens is that cash is going out. So that interim dividend should be paid by using retained earning. So the retained earning account debit, cash control account credit. Retained earning account debit, cash control account credit. Normally, these are the components that can be seen in the statement of equity changes. Now, sometimes within an year, all these, you see, will not be happening. all these. But you see, sometimes events may be occurred. With regard to those events, we have to make necessary adjustments. Then you can find out the closing amount of each column, and this closing amount should be taken to the financial position statement under equity and reserves. Now we are going to move on to the next part. Then we are going to discuss another example. Please start doing this example. We asked to prepare the statement of equity changes for the year ended 31st/3/2021. Journal entries and ledger accounts regarding above events, accounting policies and notes. For your understanding, I will show you a certain part of that. Here you see, this is how you have to make them out. Here, statement of equity changes example. Then first you see, in this manner, statement of equity changes for the year ended, and then name of the business, rupees thousands. First you see description, order share, that is revaluation reserve, general reserve, retained earning, total. Don't write anything here. You can keep space if necessary. According to the items, you can write the items one by one. Right, look at that first one. Here you can see the opening balances. You can see the opening balances of each column. Now here ordinary shares 10,000, and then revaluation reserve, that is 1,000. General reserve 22,500, retained earning, that is 3,500, total is, that is 37,000. Then first you see total comprehensive income. Now total comprehensive income is concerned, you see revaluation reserve is there, that is revaluation, what you call the comprehensive income is, that is 2,000. Now look at that, that is 2,000. Revaluation, what you call the comprehensive income is, that is 2,000. And then you see that retained earning is, that is 6,500. Total is 8,500. See whether you are having problems over that. Yes, here this is how definitely you have to take it as total comprehensive income as a single item. Then when recording in columns, you see revaluation reserve should be recorded in the revaluation, which what you call the comprehensive income is the revaluation, and then profit for the year should be recorded under retained earning column. Total should be taken to the total column. And then you see issue of shares. Now due to issue of shares, what happened is that cash control account debit here 2,500, order share account was stated capital account credit. Next part, capitalizing reserves is concerned 100. Then what happened is that reserves are capitalized by using general reserve. It is said that reserves are capitalized by using general reserve. So that general reserve debit, stated capital credit. General reserve debit, so that subtracted stated capital or share account credit. See whether having problems are there?
Yes, sir.
Right share issue, value is 1,000. And then due to right share issue, double entries, cash account debit, stated capital account credit. So that stated capital or order shares value increase. Next one, paid dividend. Due to paid dividend, double entries, what you call retained earning account debit. As cash is going out, cash control account credit, retained earning account debit, so that subtracted. Proposed dividend is concerned, it is a dividend which cannot be paid, still proposed. Because you know that if there is a proposed dividend, the moment it is proposed, you are unable to pay. The board of directors is unable to pay. It should be approved by the annual general meeting, by the shareholders. So that until and unless it is approved by the annual general meeting, necessary amounts cannot be paid. So that proposed dividend can be, you see, mentioned here as a note or disclosure. Here, this is the note. This is the disclosure. You are given a single mark for that definitely. The board of directors has proposed final dividend of 30 lakhs for ordinary shareholders. This is what we call the disclosure or note on financial state, not on financial state. Now look at the here ledger accounts. If you can visualize ledger accounts, first one is here opening balance, retained earning opening balance here. Then you see general reserve opening balance here, and then revaluation reserve opening balance here. Then first one is concerned share issues here, issue of shares 2500. Normally, due to this share issue, what happened is that here you see share issue account, that is 300. You see receipt of cash, share issue account credit, cash account debit, and then next one, when cash is that is sent back to the subscribers without that is allotting. You see share issue account debit and cash account credit, and then only 2500 is taken to the stated capital account. Double entries, share issue account debit. Here you can write it as share issue account 2500 credit. I have missed it here, but you see 2500 should be. Then in the ledger account as well, retained account debit. Share issue account debit as stated capital account. Stated capital account should be credited as share issue account. Now let's see how to capitalize the reserves. Here, reserve capitalization is concerned. Let's try to understand that capitalizing of reserves, actual value that should be. You see here on 1st January, 1st 2020, 50,000 ordinary shares were issued. Now that is share issue. On 7th 2020, the board of directors capitalized reserves based on shares remain before issuing shares on 1st 2020, 5:1. So that before issuing shares, how many shares were there? Total of shares, that is according to given details. Now this is the number of shares. Number of shares is, that is 200,000. Number of shares 200,000. Then out of I'm going to omit 3 zeros here. Total of number of shares, that is 200,000. And then you see capitalization reserve is 5:1. So that it should be divided by 5. Then you see number of shares issued, that is 40. Then you see the subscription value of the share is, that value of a share is, per value of a share is 50. So that into 50, then into 50. Now look at the value of that. Then you see total, that is 2000. Now here 200, 5:1, yes, 200, that is 2000. Right. Now this is how you have to complete. Right. Then you see we are going to discuss the other one. That's what we call statement of financial position. We should call statement of financial position of a company. Here look at the statement of financial position of a company. You know that here based on entity concept, you see name of the business or company. Statement of financial position as at. You have to put the date based on money measurement, periodic concept. Here rupees 1000 based on money measurement concept. Here you see notes column, rupees and then rupees value. Here non-current assets. Now these are the facts to be highlighted. Non-current assets should be highlighted. Non-current assets. Under non-current assets, you are having property plant, and then property plant is there. Then you see right of use, leasing vehicles. Leasing vehicles are there. Investments maybe. Any other, you see, long-term investment. Now there is a special note on property plant equipment, that is number 4. 401, you can take it as disclosure 1, no matter. Disclosure 1. Right of use, lease property, leasing property, that is number 2, D2. Investment long term. Then look at the next title. Current assets. Next title is current assets. Then inventory, trade payable. It is not debtors, trade payable. Other current assets. Then cash and cash equivalents. Treasury bills. And then bank balance. All these are cash and cash equivalents. Then you see the total assets. This is how you have to prepare the sketch of financial statement. Total assets. And then you see the other one is under total assets, that is equity and liability. Now these are equities. Here reserves. 2 of the reserves. and then non-current liability, and then current liability. A non-current liability, bank loan, leasing creditors, non-current portion. Current liability, leasing creditors, current portion, trade payable, current portion of long-term debts. That type of items can be taken. Right. Then you see, it is better for us to do the next one. I'll explain once again. Here you see, normally, here you can write it as that is Rohini PLC. Statement of finance person as at 31st 2021, rupees 1,000. Here you see non-current assets. You see, normally non-current assets are concerned in the phase. This is what you call the phase of the financial position. In the phase, you have to show only property, plant, equipment as a total. Let's look at that fourth note. Now, this is the note. Fourth note is concerned. Here you see fourth note. A separate, you see, detailed table should be prepared. Now, all the property, plant, equipment components should be separated, taken as land, building, motor vehicle, machine, office equipment, computer, any other property, plant should be taken. Here, opening balances, if there are opening balances, if there are purchases during the period. If there are purchases during the period, it should be added. If any revaluation are there, revaluation is there during the period, it should be added. Understand? If there is any disposal or sale, it should be recorded here. Depreciation adjustments should be recorded here. For depreciation adjustment for revaluation. Then you take the closing balance of cost. Now this is what we call cost table. Here, this is the cost of land to closing balance, building of closing balance of building, closing balance of motor vehicle, closing balance of machine, closing balance of equipments, closing balance of that is computer, closing balance of total of assets. Now this is what you will property plant cost component. Here you see accumulated depreciation. You know that property plant is concerned. This is how you have to prepare the table. Can you remember? Earlier we prepared the table. That is, you see cost. Then you see cost minus accumulated depreciation minus accumulated, accumulated depreciation, and then you get what you call net value. This is how you prepare the financial position earlier. Now here, this is the cost table. This is the cost of that table. Cost table. Only cost is recorded. And then here you see accumulated depreciation. You can see accumulated depreciation. Here accumulated depreciation. You know that normally no land depreciation is made. No land depreciation is made. Normally lands are not depreciated. And then here opening balances. No land depreciation. Others are having opening balances. Here you know the opening balance. Depreciation.
So the opening balance of the depreciation.
Yes, this is opening balance of depreciation, which means opening balance of accumulated depreciation of each asset. And then if there is any annual depreciation, it should be added. It should be added, annual depreciation. If there is any disposal of asset, here accumulated depreciation so far should be subtracted. Accumulation at the point of disposal. Understand? Depreciation adjustment for revaluation. It can be done when you are doing examples. Depreciation adjustment for revaluation. Here it should be recorded here. And then you see closing balance of that is what we call the accumulated depreciation. Then you see in the end, you see land, no accumulated depreciation. So that total is what we call the net value or carrying value. And then here building is concerned. Building, that is what we call cost value. Here cost value, this is the cost value. And then you see here accumulated depreciation out of cost. Accumulated should be subtracted, then you are getting the carrying value. Can you understand?
Yes, sir.
And then here motor vehicle, there is a disposal motor vehicle. Now here total value. And then here you see the total. Out of this total, this amount should be subtracted. Then you get the final value. In this manner, you can find out the final values. Now, carrying values total should be taken here. This is the value that should be recorded. In the crossword, all values should be recorded. All values should be recorded to the crossword. Then you see here, you know what we call carrying value. That carrying value should be taken here to the financial position. Here, that carrying value should be taken as property, plant, equipment. Can you understand?
Yes, sir.
Yes. And then right of use motor vehicles. Right of use of lease property. If there are any leasing properties, leasing vehicles, they can be taken under the category of property, plant, and equipment. They should be mentioned separately. That is why right of use motor vehicle. Number 5. But look at that number 5. Right of use motor vehicle. Here you see if there are any right of use motor vehicle, it should be separately taken. If there is any right of use motor vehicle, it should be separately taken. That is why there you have to understand. And then inventory, trade receivable, other current assets, cash and cash equivalents. Then you see equity and liabilities, stated capital order shares. Here you see 3 reserves. Now you see the equity change values, final value should be taken here. Order shares, revaluation reserve, general reserve, retained earnings. Now these are the values of final values of that is what we call equity change state. Current liability, non-current liability, bank loan, lease creditors, non-current portion, current portion, non-current portion here, non-current portion here. So non-current portion here, current portion here. Trade payables, current portion of the long-term debt. That's all. OD. Then you see equity and liability should be equal to total of assets. Total of assets. Right. Now, shall we start the next sum? First, you drop the format. Let's look at the answer. Here you see the investment in order shares and the fixed deposits. Let's see whether you are having problems over there. Property, plant, equipments, and then current assets, inventory, trade receivable, and then prepaid insurance, accrued income, cash and cash equivalents. Cash and cash equivalents. Here I mentioned marks here. Then you see stated capital reserves, stated capital order shares, retained earnings. Reserves are concerned retained earnings, general reserve, revaluation reserve, current non-current liability, bank loan, leasing creditors, current liability, trade payable, other payables. Here, trade payables can be taken here. Look at that. Trade payables, provision in payment, trade receivable. Trade receivable 6425, out of that provision for impairment loss on receivable subtracted. Provision for impairment loss on receivable subtracted. Then you are getting 6400. 6400 is the value that should be recorded here. 6400. It is recorded here. And then you see here other payables, accrued electricity 40, leasing creditors current portion 350. Then total is 390. Here are the payables.